55%. That is the share of Americans who told Gallup this year that their finances are getting worse. And that is the highest number Gallup has recorded since it started asking that question back in 2001. So if you have been feeling like the math just does not work the way it used to, you are not imagining it, and you are definitely not alone. Today, I am going to show you the debt numbers sitting underneath that feeling, why your interest rate is not moving the way you think it should. And by the end of this video, you will have specific moves to make based on where you are financially right now, whether you are living paycheck to paycheck, building a cushion, or sitting on some savings already. Let's start with where this actually shows up in your life. Credit card delinquencies just hit their highest level in 15 years. 13% of card balances are now 90 days or more past due, and total credit card debt in this country just crossed $1.25 trillion, a record. The average card is charging something like 21.5% interest. So if you are carrying a balance, that gap between what you owe and what you can pay down is getting wider every month, not narrower. And it is not just credit cards. In Gallup's own survey, the cost of living topped the list of financial worries. Again, energy costs jumped to their highest reading since 2008, and about 6 in 10 Americans say they are worried about paying for a medical emergency or saving enough for retirement, groceries, utility bills, insurance premiums. None of that shows up in a stock market chart, but it shows up on your bank statement every single month. This is not a vibes problem. It is showing up in the actual numbers, and it is showing up for people across every income bracket, not just the folks living closest to the edge. Now here is something most people get wrong, including a lot of finance shows that should know better. There is a specific number buried in the bond market that explains why your mortgage or your auto loan rate has not budged even when everyone is talking about the Fed cutting rates. I will show you exactly what that number is in a minute. But first you need to understand where all this debt actually sits, because the way people usually describe it is a little misleading. You may have heard some version of a $72 trillion debt crisis number floating around. Here is how people get there. Household debt in this country, that is mortgages, car loans, credit cards, is at an all-time high of $18.8 trillion, with mortgages alone making up $13.2 trillion of that. Corporate debt, loans, and bonds that businesses carry adds up to roughly $14.5 trillion, and the federal government's total debt is just under $40 trillion. Add those three buckets together, and yes, you get north of $72 trillion. But here's the thing. Those three buckets do not play by the same rules, and lumping them together to make a scary headline number is a little misleading. Your mortgage and the federal government's debt are not the same animal. The federal government can issue new debt more or less indefinitely because the entire world still transacts in dollars and buys our Treasury bonds. Your household budget cannot do that. If you default, nobody bails you out. So when someone throws a combined number like that at you, ask which bucket they are actually talking about, because the household bucket, the one at $18.8 trillion, is the one that actually determines whether your family can make rent this month. Okay, here's that number I promised you. The Fed's benchmark rate right now sits between 3.5% and 3.75%, but that is not the rate that sets your mortgage or your car loan. The 10-year Treasury yield, which is what actually drives long-term borrowing costs, is sitting around 4.5% to 4.6%, and the 30-year is above 5%. That is a big gap. The Fed can cut its own short-term rate, and your mortgage rate might barely move because the bond market, not the Fed, is pricing in its own worries about how much debt the government needs to sell and who is going to buy it. That is why cash and short-term treasuries have stayed relatively attractive, even while everyone waits for relief that has not fully arrived yet. And if you want to see what happens to a country that does not have America's advantage of being the world's reserve currency, look at Japan right now. The yen just fell to its weakest level since 1986. Japan's government debt load is roughly twice the size of its economy. And at the end of July, the US and Japan stepped in together to prop up the yen for the first time since 1998. When a currency loses that much credibility that fast, everyday costs go up for regular families there. everywhere. Imported energy, imported food, all of it. That is not a crisis knocking on our door. Our position is genuinely different because the world still saves and trades in dollars. But it is a real-time example of what losing control of your own borrowing costs actually looks like. And it is exactly why the dollar's status is worth paying attention to, even if you never trade a single currency in your life. So put it together. Debt is elevated across every bucket, delinquencies are climbing, and the interest rate relief a lot of people are waiting on may take longer to reach your wallet than the headlines suggest. None of that means panic. It means get ready for a stretch that might be tighter for longer than we would like, and there is a lot you can do about that starting today. If you are living paycheck to paycheck right now, your first move is to attack whatever debt is charging you the highest interest rate, that is almost always credit cards averaging over 20% before anything else. Call your card issuer and ask about a hardship program before you miss a payment, not after, because that conversation goes very differently on your terms instead of theirs. And build even a tiny buffer, $50 or $100, somewhere your card cannot reach it, so one surprise expense does not turn into a new balance. If you have some savings and steady income, this is the moment to actually confirm your emergency fund covers 3 to 6 months of essential expenses sitting in a high-yield savings account or short-term Treasury bills, not a checking account earning nothing. And honestly, think twice before taking on new variable rate debt like a home equity line. While rates on the long end are still elevated, shop at least 3 lenders before you sign anything. And if you are in a stronger financial position with real savings built up, do not assume rate cuts are coming to bail you out on the timeline you are hoping for. If you have been putting off refinancing or restructuring debt, waiting for lower rates, run the math now instead of waiting, because the long end of the yield curve is not moving in lockstep with the Fed. Consider laddering some of your cash into short-term treasuries or CDs for predictable income, and make sure your reserves are sized for a longer, soft patch, not just the standard advice. None of this is about predicting doom. It is about matching your financial moves to what the actual data is telling us right now, not what we wish it were telling us. Do the version of this that fits your situation, and you will be in a much stronger spot than most people watching the headlines instead of the numbers. Until next time, I've been Kevin with Money Tree and Me, providing better security and ensuring better lives. Make it a great day.